I just want us to have a real conversation on wealth creation. And I want to start with a simple question. How much rent do you think Nairobi tenants pay every single month? Just think about it for a moment. I come from Vipingo, Kilifi, but I'll give Nairobi examples today because they affect us. So, Nairobi today has roughly 1.5 million households. A large majority of urban households in Kenya are tenants, not owners. They are tenants, not owners. When you put the numbers together, you find that over 1 million households in this city called Nairobi pay rent every single month. So, if the average rent across the city is somewhere in the mid-teens to 20,000 shillings a month, because some will pay 5,000, others will pay 20,000, others will pay 80,000 and above. It means Nairobi tenants collectively pay somewhere around 20 billion shillings in rent every single month. Think about it. 20 billion shillings in rent paid in Nairobi. So, when you look at the 1.5 million household in Nairobi, 79% of those households, or 80% of those, they rent. So it is reasonable to say that roughly 1.2 to 1.3 million households pay rent at an average of 20,000 shillings a month. When you look at the entire spectrum of slums, affordable housing, mid-market, all the way to the high end. Then, total rental income paid every month, when you take these 1.2 to 1.3 million renting households, and you do the maths with an average of 15 to 20,000, that's how you arrive at between 18 to 25 billion month in rent. And that gives us the monthly average of 20 billion I mentioned earlier. Let's do the math. How much are those amounts per year? Those are 200 to 300 billion every year. Quietly moving from tenant's pocket to the landlord's pocket. So, the real question is, what share of that river of cash is flowing into your pocket, into your Sacco, into your family balance sheet? Something to think about. The good thing here is no one will tell you to answer. You internalize and you go with the answer. So, the question of this keynote today is not whether there is money in real estate. The question is, what share of that river of cash is flowing into you, into your family, and those who contribute to Saccos, into your Saccos. And how much or what share of that will flow into the balance sheet of your family or future family balance sheet. So, the structural opportunity that's available to us today, being 22nd of November 2025, is that the housing opportunity is not a 2025 story. It's a 2040 story. Let's step back from the monthly rent numbers and look at the bigger picture. Nairobi population has grown from about 500,000 people in 1969 to over 4 million today. And the city is still growing. We have rural-urban migration, a young population, new companies are setting up, UN agencies is expanding, embassies, NGOs, logistics firms, tech companies, and regional headquarters. And all these, they are choosing Nairobi as their destination. When you look at it this keenly, you realize this is not a one-year trend. This is a structural wave that runs into 2030, 2040, and beyond. At the same time, our formal housing stock has not kept up. That's why we have a huge housing deficit today. Formal rental housing is not a short-term opportunity. It's a multi-decade gap. So when we ask, will there still be a market for rental housing in 2040? The answer is yes. Unless Nairobi stops growing, unless people stop being born, which I don't think will happen, unless businesses stops coming here, as long as Kenya keeps urbanizing and the economy keeps formalizing, there will be demand for decent, safe, and well-located rental housing. That is the first pillar of wealth creation through real estate. You are not speculating on a fashion trend. You're not speculating on a fashion trend because fashion trends come and go. You're plugging into a structural need of a growing city. So the next question then is very personal. Is there still room for an ordinary Kenyan, not a billionaire, not a fund manager, to make passive income and build wealth through real estate? We sometimes feel like we are late in life. We see the early land buyers who bought land at 50,000 an acre and are now selling at tens of millions. We hear stories of big landlords who own a whole street. It can feel like the game is over. And sometimes it can be quite discouraging. But the game is not over. I hear an amen. The game is not over. What it has done, it has just changed. Today, instead of buying hundreds of acres on the outskirts, most people will build wealth through, number one, apartments in strong rental locations, specialized housing, such as student accommodation, niche assets like Doctor's Plaza, neighborhood retails, logistics, and warehouses. And I'm sure you are familiar with this. Some of the players in the real estate industries have really conquered those niches, and they are doing very well. The opportunity is no longer about land banking. It is about owning income-producing assets in places where people not must live, must work, must learn, must receive healthcare, because those will be constant. So, what are the paths to enter into real estate without being rich? The big barrier most people feel is funding. People say, I don't have money, so real estate is not for me. And I want to challenge that thinking by showing you practical pathways that many ordinary Kenyans are already using. Path number 1, payment plans with the developers. Today, many reputable developers offer 3 to 5 year payment plans. You pay a deposit of say 10 to 20%, and then you pay monthly or quarterly installment during construction. The beauty of this model is that you lock today's price, but you pay over time. As long as the developer is credible and the approvals and titles are clean, this can be a smart way to accumulate real estate assets. Path number 2, the Kenya Mortgage Refinance KMRC-backed affordable mortgages. For the first time in our history as a country, we have a wholesale institution that refinances bank and Saccos, and they can offer long tenor, fixed, single-digit interest rate mortgages. In practical terms, this means that some banks and Saccos can lend you at 9 or 9.5% fixed for up to 20 or 25 years, especially for first-time homeowners. And this is where the young people need to take advantage, because if you are, I don't want to say old, the 20, 25 years might not work, but if you are young, this can really communicate well to you. This is transformative because you are no longer gambling with interest rates. You know your installment in shillings for the next 20 or 15 or 25 years, where rent in the market continues to rise over time. I'm sure for those of us who paid rent, you know the rent you're paying in 2015 is not the same as it is today, unless you've downgraded. Path number 3, Sacco mortgages. Many of you already belong to Saccos. Traditionally, you saved, you took a loan, you bought a plot. Now, Saccos are providing mortgage products. The rate could be around 12%. But they understand your income pattern. They often have more flexible terms, and they can be a friendlier way to enter into real estate. So, the mind shift is this. If you already have the discipline to save into a Sacco, and I'm sure if you don't remit your contribution, they will remind you you are becoming dormant, then you're already halfway to owning an income-producing property. The next step is to move from saving for 15 years to servicing an asset that will pay you rent for 50 years and beyond. Let's do some numbers so that this doesn't sound like a theory. Suppose you're considering a property that is worth 5 million shillings. Many people are shocked by the sticker price. But when you break it down into monthly installments, it becomes more tangible. Let's look at scenario 1 for the same 5 million property. You go through the KMRC route and you finance all of it. at a fixed rate of about 9.5% and an average period of 25 years, you're looking at, give or take, 44,000 shillings per month. If this rate was to be 10%, you're still looking at mid 40 something thousand shillings per month. Now I want you to think of this in a different way. This 5 million shillings property is like taking a loan to buy a high-end car. The difference is that the car depreciates to almost zero over time, while this 5 million property appreciates in value over time and earns you rent. Scenario B, the same 5 million property, you finance it through a Sacco at 12%. You're looking at an average monthly payment of 60,000 shillings per month over a 15-year period. So, the takeaway from this keynote is that to get a 5 million shillings property, you're looking at a commitment of monthly of 45,000 all the way to 60,000 a month, depending on the structure and the tenor. Is it expensive? Yes. Is it impossible? Not necessarily. Especially if you combine your income, and for those who have cooperative spouses, you combine your spouse's income, or you combine jointly with friends, siblings, and others. It's doable. I want to look at as a case study of a studio or a junior one bedroom. Allow me to use Two Rivers, which is something that most of us are familiar with, or anything that is near within that corridor. Now, when you look at the service charge of a junior one bedroom or a studio, it's about 5,000 shillings per month. And for that location, that property will fetch you somewhere around 40,000, and if you furnish it and you give it out as a corporate or diplomatic rental, it can fetch more. So let's be conservative and say from the rent of 40,000 and you pay your 5,000 shillings in service charge, you can do the math. You can left with about 35,000. Now, compare these to the KMRC mortgage repayment, where you're paying about 44,000 a month. In the earlier years, your rent will not fully cover the mortgage. You likely top up 5 to 10,000 per month from your salary and from your other sources of income. And for many of us, both the lazy and the hardworking ones, this is where we give up. This is where we give up because we want an asset where the rent instantly pays off the loan from day one. But real wealth creation doesn't work like that. In year 1 to year 5, in the building phase, you're using your income to bridge the gap, while the tenant is also contributing. Over time, as rent increases with inflation and market demand, your 35,000 net can grow to 40, 45, and beyond. And the good thing is, with mortgage under KMRC, your installment is fixed. So at some point, maybe in year 7, year 10, or year 12, depending on the market, the rent overtakes the mortgage installments. That is when the asset flips from being a cash flow negative to cash flow positive. That's when passive income becomes real. So the message is clear. Passive income from real estate is not free money in year 1. It is a reward for consistent and disciplined investment over time. Those who understand this are the ones who build real wealth. So, how do you choose then where to buy this 5 or 10 million shillings asset or beyond? Let me suggest simple 4-point filter. Number 1, demand anchors. Ask yourself, what permanent demand exists around this property that I want to buy? Is there a major employer, like at the UN, the embassies, a business park, special economic zone, universities, hospitals, logistic parks, industrial, major malls? Because this is an anchor that will keep your unit occupied across cycles. Number 2, the tenant profile. Be very clear who your likely tenant is. Are you targeting students, young professionals, corporate managers, diplomatic staff, families, and so forth? The clearer your tenant profile is, the easier it is to design, fit out, and price your unit correctly. Number 3, connectivity and services. This is simple but powerful. Is there good road access? Is there public transport? Is there fiber internet? Is the area secure? Ask yourself a personal question. If I had to live here for 2 years, would I honestly be comfortable? If the answer is no, your potential tenants will also struggle. Number 4, the numbers. Run the yield. The yield is the annual rent divided by the purchase price. If you buy a 5 million and you're getting 300,000 shillings of rent in a year, that is a 6% gross yield. In many Nairobi locations, yield sits around 5 to 6%. You ideally want to be in the 8 to 10% range, unless you're in an exceptional location with strong capital growth prospect. Location is not just about prestige, it's about the combination of demand drivers, tenant profile, livability, and the yield or the numbers. Now, let's look at beyond the apartments, the real estate ecosystem. Many people think real estate equals only buying a flat. But the ecosystem is much wider. And it offers different avenues depending on your skills and networks. There is student housing near universities and technical colleges. There is healthcare space, the doctor plazas I spoke about, the outpatient clinics and diagnostic centers in high-density areas. There are schools and daycare facilities in emerging suburbs. There is neighborhood retail, small shopping centers with supermarkets, pharmacies, ATMs, and food outlets. There is logistics, warehouses, and light industrial facilities along corridors like Mombasa Road, the Eastern Bypass, the railway, and the port networks. All of these are real estate players. In some of them, you own the property and lease to an operator. In others, you might be both the owner and operator. The point is this: you do not have to play only one game. You can find the niche where your expertise, your network, and your capital best aligns. Then, if all these opportunities are available, why do people hesitate? And what do they miss? And that's a question we need to ask ourselves. I'm standing here, and somebody is wondering, if real estate is such a powerful wealth creation tool, why aren't more Kenyans with good incomes and strong savings already deeply invested in it? There are several reasons. First, fear of complexity. From titles to lawyers in the house, hello, approvals, service charges, it can feel overwhelming. So people postpone decisions and stay where they are comfortable. In a savings account, in a money market fund, or any other area that is comfortable. Second, fear of illiquidity. Shares and T-bills can be sold in days or even hours. Property takes time to sell. Many people overvalue liquidity in the short term and undervalue compounding in the long term. Third, short-term thinking. We are conditioned to think in 5-year cycles, election to election. But property really rewards you over 15, 20, or even 30 years and beyond. The people who win are the ones who can think in decades. Fourth, bad experiences. We all know someone who lost money in a fraudulent land, in an off-plan project that was never delivered. Those stories are real and painful, but they are not the entire story of real estate. The answer is not to avoid the asset class. The answer is to improve due diligence, partner with credible developers and professionals, and structure your investment properly. Fifth, mismatch between the product and income. Sometimes a project targets a luxury segment, while the real demand in that area is for affordable housing. When investors buy into the wrong product for the local market, they suffer vacancies and low yields, and they conclude that property doesn't work. Most Kenyans are not scared of the property itself. They are scared of making one big, irreversible mistake. Our work as professionals, as developers, as advisors, is to replace fear with good information, good partners, and good structures. So, many of you in this room, you hold shares. You hold government bonds. You hold money in money market. You may even hold private businesses. So the question is, should I abandon my other investment for property? The question is, should I add a well-chosen income-producing real estate as another pillar of my portfolio? So, as I get out of this stage, I want to be very clear. Real estate is not risk-free. If anyone tells you that property never loses value, walk away. Serious investors talk honestly about risk and how to manage it. There is interest rate risks. Mortgage rates in Kenya have historically been double digits, and that's why KMRC comes in. And sometimes, where possible, when you are taking the mortgages, it's always good to mark up by 2 or 3% just to know that you are stressing your ability to pay in case the interest rate goes up high. There is a risk of the location. Things change over time. And there's the developer and the title risk that we discussed. So, as we close, let's think of the numbers that I gave you earlier about the 20-something billions that flow from the tenant pocket to the landlord's pocket every month. That river of money is not going to stop flowing. In fact, as the city grows towards 2040 and beyond, that river will widen. You have a choice to tap into this river. So, real estate is not magic. It's not overnight wealth. It is the quiet compounding. So, as you go home, I want you to look at these photos. And these photos will just give you a glimpse of the conversation that was in 2010 and 2015. And today we're in 2025. When I say the opportunity of the structural opportunity is a 2040 story, this is what I mean. So these are people who take leap of faith and invest. This is Vipingo. And that is not one of our developments. We just sold the land to an investor. That's another investor. Ownership economy. They come from different parts of the world and they find opportunities availed and they take it. That's somebody else who has taken a leap of faith and they are now participating in ownership economy. Of course, our work is to support you to make sure that whatever we do as we create wealth, we are sustainable. Sustainable by giving you good infrastructure. This work does not happen overnight. It's a lot of many years of work. So, as I get off this stage, I'm willing to share my story. And we have a booth. You can pass by there. Leave us your email. I will give you the story to read it at your own time. Thank you very much.